studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
From an accounting perspective, salaries and dividends may both result in cash leaving the corporation, but they are not treated the same way. In fact, they affect completely different parts of the financial statements, and understanding this distinction is essential for anyone studying corporate accounting or taxation. Let's begin with salary. When a corporation pays a salary, it is considered an operating expense because the payment is made in exchange for services provided by an employee. This salary expense appears on the corporation's income statement, where it reduces the company's net income. Since the corporation reports lower net income, it also reports lower taxable income, which is why salary is generally deductible for corporate tax purposes. A dividend, however, is treated very differently. A dividend is not an operating expense because it is not paid for services performed. Instead, it is a distribution of profits that have already been earned by the corporation. Since it is not an expense, a dividend never appears on the income statement and does not reduce the corporation's net income. Instead, dividends are paid from retained earnings, which form part of shareholders' equity on the balance sheet. When a dividend is paid, the corporation's cash decreases, and retained earnings are reduced by the same amount. The corporation's profit remains exactly the same because the dividend is simply distributing profits that have already been earned. This leads to one of the most important accounting concepts in corporate taxation. Although both salary and dividends reduce the corporation's cash balance, only salary affects the income statement. Dividends bypass the income statement entirely and directly reduce retained earnings within shareholders' equity. So, from an accounting standpoint, salary is an expense, while a dividend is a distribution of profit. Understanding this difference makes it much easier to understand why salaries reduce corporate taxable income, while dividends do not, even though both involve paying money to the owner-manager. Although both salary and dividends result in money leaving the corporation, the accounting entries for these two transactions are completely different. Understanding these journal entries is essential because they explain why salaries affect the corporation's profit, while dividends do not. Let's begin with the salary journal entry. When the corporation pays a salary, it records a debit to salary expense and a credit to cash, or to wages payable if the amount has not yet been paid. Recording salary as an expense means it appears on the income statement. As a result, the corporation's net income decreases. And because taxable income is generally based on accounting income with certain adjustments, salary also reduces the corporation's taxable income. Now compare that with a dividend. When a dividend is paid, there is no expense recorded. Instead, the corporation records a debit to retained earnings, or sometimes to a temporary dividends declared account that is later closed to retained earnings, and a credit to cash. Since the transaction never passes through the income statement, the corporation's net income remains unchanged. This is one of the most important differences in corporate accounting. The shareholder may receive the same amount of cash whether it is paid as salary or as a dividend, but the corporation records those payments in completely different ways. Salary is recorded as an operating expense, while dividends are recorded as a distribution of accumulated profits. You can also see the different flow through the accounting records. A salary first affects the income statement by reducing profit. Lower profit then flows into retained earnings at the end of the accounting period. A dividend skips the income statement entirely and reduces retained earnings directly. In both cases, cash decreases, but the path through the financial statements is very different. The key takeaway is simple. Salary flows through the income statement before affecting retained earnings, while dividends bypass the income statement and reduce retained earnings directly. This difference in journal entries is the foundation for understanding why salaries and dividends have different accounting treatment, different tax consequences, and different effects on a corporation's financial statements. From an accounting perspective, the real difference between salary and dividends becomes clear when we follow their impact through the financial statements. Although both payments reduce the corporation's cash balance, they take completely different accounting paths and tell very different financial stories. Let's start with salary. A salary is first recorded as an operating expense on the income statement. Because expenses reduce profit, the corporation reports lower net income. At the end of the accounting period, that lower net income flows into retained earnings, which means shareholders' equity is also reduced. In other words, salary affects the income statement first, and then indirectly affects the balance sheet through lower retained earnings. Now compare that with a dividend. A dividend never appears on the income statement because it is not an expense. The corporation's net income remains exactly the same. Instead, the dividend is recorded directly against retained earnings on the balance sheet. As a result, shareholders' equity decreases immediately, and cash also decreases, but the corporation's reported profit does not change at all. This explains why two corporations can distribute exactly the same amount of cash to their owners and yet report completely different financial results. A corporation that pays salary reports lower expenses, lower net income, and lower retained earnings. A corporation that pays dividends reports the same net income as before, but lower retained earnings and lower cash because the profits have been distributed to shareholders. This is why accountants never look only at the movement of cash. They also ask an important question. Where does this transaction belong in the financial statements? The answer determines whether the payment is recorded as an expense that affects profit or as a distribution that affects shareholders' equity. The key takeaway is simple. Salary reduces profit first, and then reduces retained earnings through the normal accounting process. Dividends, on the other hand, bypass the income statement completely and reduce retained earnings directly. Understanding this accounting flow is fundamental because it explains the different presentation of salaries and dividends in the financial statements, as well as their different tax consequences.